All right, welcome to the Freedom Life 3.0 show. This is J. Scott McMillan, and today we're looking at the fear and greed index because it just hit extreme fear. Social media is just screaming that Bitcoin is done, and the crowd is overwhelmingly short. And yet, the SEC just announced a framework that could put the entire stock market on blockchain rails. So here's why this week might be one of the most important weeks if you're not paying attention. All right, so I'm Jay Scott. I am the owner here at Freedom Life 3.0, where we help people catch up on their retirement. We do so by primarily investing in Bitcoin and a few other blue chip crypto and some tech stock assets in there, but we're long-term investors. This isn't financial advice. This is just the story of how I caught up on my retirement and how I might be able to help you understand the markets a little bit better and where we're going. All right, so let's move on here. So we looked at this chart last week. So Bitcoin, it touched about 82,000 last week, and then it got rejected. It got rejected by this 200-day moving average line. And as we talked about, this is just the average line on this chart that shows the average price of Bitcoin over the last 200 days. And when Bitcoin can't get above this, well, investors and traders, they see this as weakness in the market, in the Bitcoin market. And this week, Bitcoin definitely failed to break above that, and it's heading on its way down somewhere in the mid 50s as we speak. So what you're seeing here is that Bitcoin is just testing this 200-day line. It tested it twice, and it's getting pushed back both times. And so when it touches this, the last time it touched it, it was over $100,000. So now that it's testing it now at around 79 and 75 and going lower, well, this tells you, how far back the market has pulled back. But as you know, from watching this channel, I think that's good news in lots of ways. And the most significant is that if you're a true believer, like I am, like I hope you guys are in Bitcoin, and we're long-term investors, that Bitcoin's on sale. Really, as a long-term investor, I kind of get excited when Bitcoin's price stays kind of low. Now, not when it crashes, but when it's just kind of drifting and staying lower before it goes higher, that means I can get it cheaper because I'm always dollar cost averaging into Bitcoin. And as the price slowly is dropping, well, I'm getting some of this Bitcoin really cheap. And really, when the price is down at this range, I probably should take some of my free cash, which I don't have a lot of, and plop it in there in a little tranche because I don't think it's going too much lower. Now, we'll see each week. That's why we kind of look at the direction of where the Bitcoin market's going. Some say it could drop down below 60 again, but I think a lot of people think that when it hit 60 a couple of months ago, it probably was the low, and now we're just ranging, trying to find its price level. But as long as it's down here at this level, I'm really happy to buy. So that's just where I am focusing. All right, so let's talk about the sentiment, about market sentiment, because this is where it gets interesting for catch-up investors. So the Bitcoin fear and greed index, well, it's sitting near extreme fear. Social media is just going crazy. Their comments are really negative. YouTube reactions are negative. It's overwhelmingly bearish. People are not, they're just not cautious. They're actively confident. The prices are going lower. And here's what that data actually shows. Funding rates, well, they're negative. That means that a lot of traders are paying to short Bitcoin. Option data shows maximum pain is currently sitting below the market. And this crowd is heavily positioned in one direction, which is down. Now, this is not a contrarian view for the sake of being contrarian. But when the crowd is this uniformly positioned, the data historically shows that the contrarian play is the opposite one. Now, that doesn't mean that lower prices can't happen. Like I said, we could get into the 60s again, but this is not a picture of a market that's about to collapse further. This shows me that this is a market that is largely priced in all the bad news already. And we got the war, we've got interest rates going up. So there's some bad news out there, but I think that we're getting priced in already. I don't think we're going to go a lot lower, but we'll see. So here's how I think about it. If you're a long-term investor, and if you're watching this channel, you probably are, the moments when everyone else is panicking, these are the moments that matter the most. And not because you should panic buy, but because you should just be paying attention while others are looking away. Really good position that I like to put myself in is when the market overwhelmingly is saying one thing, it's probably best to do the opposite. it works for a lot of really savvy investors. So again, I DCA, dollar cost average into Bitcoin for the most part. So this doesn't really matter to me. It's just interesting to kind of look at this viewpoint and be thinking strategically overall. All right. So here is another bear case. I follow a guy named Juan Villaverde at Weiss Crypto, and he's got a 80-day cycle or 320-day cycle timing that he does. And he basically said that the 80-day cycle for Bitcoin around May 9th, that Bitcoin hit 82,000. And that was right on. He pretty much called in there. He's got a pretty good cycle timing. But here's what he says is coming next. The Strait of Hormuz closure has been disrupting physical goods for now months, and it's showing up in the data. The producer price index rose over 1.5 in the past month, and it's heading the highest level since February 2023. The consumer price index, it jumped nearly 1% in March and April. Now this chart shows this relationship between the 2-year Treasury yield and the federal funds rate. And historically, the Fed funds rate, which is basically how the Fed controls interest rates, it follows this 2-year Treasury for a few months lag. So don't worry too much about this. Following all this technicality, I just want to give you a general sense of another person's perspective. He sees that the 2-year has been rising since the Iran conflict, and the Fed is really on pause right now. So Juan's argument is that inflation, it keeps ticking higher, and this is going to translate into rate hikes by the Federal Reserve. And that's going to pour cold water on both the stock market and the crypto market. We all kind of understand that. But here's the part that I want you to hold on to. The last crypto bull market started in October 2022. And while the Fed, they were still raising rates. So what changed wasn't the rate hikes that was stopping. It was the 2-year Treasury yield finally stopped climbing. And markets are forward looking, so they price things in before they happen. So if you put this together, what does this all actually mean? If you're 50 something and you're behind your retirement, you're just trying to figure out what to do. What does all this chart stuff have to do? Well, first, if you have more than 4 or 5 years before you're gonna need any of this money invested in Bitcoin, you can just chill and move on, really. This information is just to get a sense of the market direction. It's not a selling point, but as you can see, it may be a buying point. So we'll see. But this first correction that Juan expects a modest pullback, not a crash, but his model shows $70,000 as strong support. So he expects a significant low by late July, which he calls this 320-day cycle low. And that would mark the end of the current cycle and the start of a more bullish one. So what he's saying is that in July, he thinks that Bitcoin's just going to hover around here. It might go lower, might hit 70K. And then he expects we're going to be in the next bull market. So, I mean, we'll see. These are just all different theories and ideas, and I like to just keep abreast of a couple different ones and bring that to you so we can understand together where is this market generally going. But again, for long-term investors, we're not really worried about if we're going to sell now or buy now necessarily. I dollar cost average in. I just keep putting money into Bitcoin because I know it's going higher I have strong conviction that it's going higher in the long run. All right, so interesting news. So while everyone is focused on the short-term price of Bitcoin, the SEC, they just put out a framework for tokenizing stocks. That's blockchain-based versions of publicly traded equities on these blockchain rails. So you can trade 24/7 on different crypto platforms. So the DTC, now that's the organization that is at the center of all U.S. security settlements, they're launching a limited production of these trades of tokenized assets there in July. The NASDAQ got approved, and the New York Stock Exchange parent company partnered with a crypto exchange. So this isn't speculation anymore. This is an actual infrastructure. The entire financial system is being rebuilt on crypto or digital asset rails on blockchain. That's a $126 trillion global equity market that's starting to move onto blockchain technology. So why is this important? Well, the digital asset market is going from 2.5 trillion today to potentially 100 trillion. Let that sink in. If that's the trajectory, the question isn't whether you can afford to be in this market. The question is, whether you can afford to stay out of the digital asset market. Digital assets are the future. And right now, it's all new. And everyone is still trying to figure this out. But getting in early is the key. So my recommendation, not financial advice, just something that I'm doing here, is I try to find a couple of digital assets that you can understand, that you believe that they're going to be around in the future as the world moves more and more into this blockchain future. And we ride a few of these digital assets into the future. So obviously Bitcoin is my major asset that I'm holding, but I do pick a couple other digital assets that I think are going to be around. Basically the blockchain rails. What are all these new applications going to run on top of in the blockchain world? Well, Ethereum is the second largest digital asset out there. So I'm betting that a lot of financial firms that are moving from traditional finance over into this new blockchain digital asset era will go on to Ethereum. So I think that's going to rise. Solana is another blockchain network that is really fast, really efficient. And so I have really good, strong conviction of those. So a little portion of my portfolio goes into these because I believe that in the next 5 or 10 years, these assets are going to be going up, doing better. So I know what some of you are probably thinking. You're like, hey, come on, Scott, Bitcoin just dropped 5% this week. It can't even break above this 200-day moving average. And inflation is rising. Rate hikes, well, they probably are coming. And you're telling me to pay attention to this? Well, yeah, exactly. Like I mentioned before, this is the risk that everyone sees. They see this volatility, Bitcoin and digital assets moving up and down. This 5% drop. I mean, we see 20, 30% drops, and it feels really scary. But the risk that nobody is talking about is the slow and visible erosion of your purchasing power that's sitting in assets that don't keep up with real inflation, which is at least 7 to 10%. So you're losing 7 to 10% if you're just sitting in cash for sure. And if you're in even index funds in the stock market, what does that earn? 5, 6, 7% at max? You're either just treading water or you're falling back a little bit. You need to be in assets that can earn 15 to 20% average annually so that you can catch up over the next 5, 10, 15 years. You're not a 20-something that has 30, 40 years to compound at 5 or 6%. You need to catch up. And that's why we pay attention to these digital asset markets, because they do give you those rate of returns that can catch you up. And the volatility that you have to flip in your mind isn't that it goes up and down. Because again, if you're in this for at least 4 or 5 years, 10 years, the volatility is actually your friend. That's what's going to give you these really great rate of returns. So that's a way to just flip this and have you understand that, that volatility can be your friend if you understand it and manage it. So Bitcoin is really one of the few assets that it really increases the strength of a portfolio, even though it has a lot of volatility, which in the past, portfolio managers didn't like really volatile stocks because it messed with your portfolio. But Bitcoin has one of these, what I call volatility drags. When the volatility, it can be so high up or down, it can mess with your portfolios. But Bitcoin averages on its upside so much, 100, 200, 1,000% when it's in its upside, that it overcomes that volatility drag. I'll talk more about that in later videos. But really what you need to understand is it more risky to stay in low volatility index funds that really aren't going to get you to your number in the short amount of time that you have? If you're in this catch-up mode. Or understand how volatility 1 year can be scary, next year can be up and down, but if it averages out and you have long-term enough horizon, it really is a way to catch up. So here's one thing that you could do this week. Go find one of those retirement calculators and put in there what 7% looks like. So you've got $100,000, let's say, at 7%, what does it look like? And then put in 20%. And you can see that in the 5 or 10 years or 15 years that you have left to catch up, that 7% won't get you there. But 20% get you to that number where you can live comfortably in your retirement. And so this will help you understand. I've actually got a what I call the Catchup calculator. I'll put a link to it in the description. It actually, you can put in there what those rate of returns are that you need. start off with 0 inflation. Like I've got a number there. Start off with 0 or put in 2 or 3 inflation and see what that number in 10 or 15 years is. Then put in 7% inflation. And you'll see that if you're only earning 7%, you're treading water. But if you're earning 20%, that's the number I like to use, even at 7% inflation, that's going to get you to that number in that 10 or 15 years. It's quite eye-opening. It's what really opened my eyes to this whole thing, and I'm going to give that to you. I think it'll really be eye-opening for you. So, all right, so that's it for this week. Just remember, 180 paychecks. It's not too late. You've got 180 opportunities. That's 15 years out that you can catch up. So I'm J. Scott McMillan. Stay the course, sleep well, relax, and I'll see you next week.